Good morning. From the Asia Pacific, half an hour away to the opening bell, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles. Let's get to your top stories today. Traders are weighing the possibility of a second Trump presidency, sending Treasury yields higher. We are also on correction watch for market stocks in Hong Kong as markets reopen after a long weekend. Now, the PBOC moving to stop this bond bull market in China in its tracks by announcing it will borrow government debt from primary dealers. Plus, a stock to watch is our BYD. Quarterly sales accelerating to a record, putting it within striking distance of overtaking Tesla. Right, equity markets across the region about an hour into the Japanese and Korean market sessions here, mostly lower. We're just getting a little bit of a tug higher from some of these names in Japan, but all things equal, in terms of market breadth, we're negative going into this reopen in Hong Kong. Today on price, though, as you can see on your screens, we're slightly better. Slightly stronger still in the US dollar, and certainly when you do get weakness coming through in the Japanese yen, and more broadly, of course, when you look at where we are trading, of course, in the euro, the chances are it's going to be very difficult for Asian FX to do the opposite, right? Now, among the many things we're tracking today, obviously this bond pullback we're seeing in treasuries, for example. So just keep in mind, at the current levels of give or take 4.5% on the 10-year yield, we're coming off the worst 2 days for U.S. treasuries going back to early April. Very steepening, of course, overnight, and as you can see, that's steady as we speak. Let's see what happens, of course, as we make our way into the trading session today. Golden Dragon Index overnight, just a recap of what happened there. That joined in the rally, of course, what we saw overnight and within the sort of Chinese market space in the U.S. overnight. It was EVs very much in focus, hence we're looking at that specific group of stocks going into the open today. BYD was at 1.2%, record sales there. You're also getting a beat across some of the deliveries across some of the other EV plays in the U.S. session. Looking at the open today, in the reopen in Hong Kong at least, so, well, the onshore market is on a 2-day win streak, although there are not really a lot of volumes there. In Hong Kong, we're on correction watch. So if you missed it on Friday, MSCI China entered a technical correction. It's 10% down from the May 20 peak. We're extremely close on the Hang Seng Index. So about, a tenth of 1% likely gets us there. We'll see what happens. And, of course, the big story, though, is in the bond markets and this pullback we're seeing in the CGB space after that headline drop yesterday that a PBOC was looking to borrow some inventory from some of the brokers, perhaps putting it a step closer to adding more supply to this market. Segantii hearing taking place today. Data, retail sales, casino stocks on the back of casino data yesterday. And, of course, we talked about EV stocks on your screens. Among all these things, let's pick the brain of our co-pilot this hour, Stephen Engle, of course. What's top of mind for you, Steve?
Yeah, I think, of course, this slight cooling as well after that record, move that we saw yesterday, and on the news that perhaps the PBOC might be used, as Xi Jinping essentially alluded to a couple of months ago in a speech that left market watchers kind of wondering what this would look like. Unfortunately, we do have Min Min Lo coming up in a matter of minutes or seconds to kind of talk us through. We'll also have some analysis to see what this means long term for the sovereign bond market in China.
Yeah, they've won the battle. Will they win the war is a big question there.
Right, and there'll be some dip moves, obviously, going forward, but it's not necessarily the panacea.
Okay, nuts and bolts of the story, as Steve was pointing out. Min Min Lo joins us right now to talk us through the PBOC story, what they're doing, and what it might signal on this bond market.
Yes, so the trigger obviously was yesterday, the 10-year bond yield hitting a record low, 2.18% before paring back some of that drop. And we know the PBOC has already made several verbal interventions through the PBOC-backed newspaper trying to arrest this rally. And it also provided guidance that this yield should really be around 2.5 to 3%. But obviously the markets haven't responded, and it looks like this is the clearest signal yet that the PBOC is going to take concrete action. So it announced that it's going to borrow bonds from primary dealers, and there are two things they could be prepared to do. One is they may be prepared to sell these bonds, perhaps as early as this week, some analysts say. And another scenario could be maybe they're just trying to inject liquidity by borrowing these bonds. And there's been a lot of speculation about bond trading after those policy signals, including, as you alluded to, that President Xi's speech that began circulating around a couple of months ago. But there's a problem with this because the PBOC doesn't hold a lot of government debt. They only have 1.5 trillion yuan of bonds. Take a look at that pie chart that we have. Let's pull that out. And majority of those special sovereign bonds have a very short maturity date. So now they are looking to borrow, perhaps to sell, which is not a very common move in the playbook of global central banks. But also the PBOC Governor Pan Gongsheng had also said that any bond trading is going to be gradual because remember they also don't want to engineer too large a lift to that high-end yield in a way that could squeeze the funding costs for local governments as well.
Extremely delicate balance they had to strike. A fantastic explanation there of the news so far. Let's get the other angle here. Let's bring in Mark Cranfield out of our MLive team, of course, in Singapore for us. So Mark, I mean, this would be akin to maybe the PBOC tapping the brokers for some inventory, maybe akin to putting the bullets inside the chamber. Is this a form of intervention, and how is this going to work?
It's a can of worms, which the PBOC would have been trying to avoid for a long time, but they've really found no choice. As Min Min was saying, record low yields on 10-year bonds is primarily the final straw. They decided they had to do something about a market which had become very one-sided. Yields have been falling incessantly for a very long period. Of course, the backdrop is the relatively weak Chinese economy and the fact that people expect more policy easing. But even within that context, if you compare it to other major bond markets around the world, it had been very skewed in one direction. The central bank have been considering for some time how they can cool traders' appetite down, and it's been pretty effective by announcing this yesterday. You can see immediately it had a very strong effect. In the futures market had less than 2 hours trading to go before the end of the day, and yet volumes were the biggest for several months. So they compressed a tremendous amount of selling into those final couple of hours. Market ended much lower, sent out a very bearish signal. So clearly traders have been warned that the PBOC means business. They don't like seeing the market only go in one direction. They'd like to see some more two-way flows. But of course, the can of worms you're opening is that once the central bank gets involved in the short-term trading of any market, you're almost guaranteed to increase volatility. And do you really want that much volatility in your bond market? It's something that the central bank has to accept, and they're going to have to find a way to deal with. But certainly from here, you can expect as more details come through, from a day-to-day point of view, you will see the central bank more involved in the trading activity of Chinese government bonds, and eventually traders will find a way to deal with that, how to cope with those interventions. But it's going to be a pretty bumpy ride, and it will take a while before people get used to it.
And clearly, Mark, Steve Engle here, this is not a panacea for, as you alluded to, the underlying issues in the Chinese economy. How closely really are market watchers, investors looking? 2 weeks' time from now is the third plenum, where we could see some bigger, more structural policies that would address the root causes of what we're seeing right now.
They certainly are. Obviously, those events are major events for everybody. I think probably more towards the equity market than anything. The bond market is dealing with a number of other issues which are not going to go away in the near term. Very low inflation, and the fact that the economy doesn't seem to be able to get velocity to escape. So those things are going to weigh on the bond market for a long time. But in terms of equity market, there is definitely room for specific sectors of the economy, depending on where the plenum addresses itself, whether it's in the tech sector, whether it's AI, whether it's more in the industrial, wherever the signals come from Chinese leaders, which parts of the economy they want to support the most. That clearly will have a very big impact on the equity market. They're the ones that will probably see the near-term shift because of that. Other things will take much longer to play out, but definitely people are watching any signs, and often some of those things begin to get leaked ahead of it. So we'll be looking to see if anybody starts outperforming in the onshore equity market as a signal that, yes, those are the kind of companies that are going to receive some kind of push from the leaders in China when they do announce the measures coming out of that plenum.
Yeah, absolutely. Ears on the ground, as they say. Mark Cranfield in Singapore for us, our MLive strategist, really unpacking this PBOC, the CGB story for us. Back to the equity markets, of course, as we approach the reopen today, long weekend. Futures are pointing down. We are in a correction, MSCI China concern. We are very close on the Hang Seng Index, a little bit more, and we're there ahead of the open today. Right, coming up next here on the China Show, we'll get more markets analysis and the outlook from HSBC Asset Management. The head of Asia Investment Specialist, Jeff Lunt, joins us in a couple of minutes. Counting down to the opening bell, Shanghai, Shenzhen, where, by the way, we are on a 2-day win streak onshore going into the reopen here in Hong Kong. Slightly lower. We're looking at EVs. We're looking at casinos. The opening bell 20 minutes away. This is the China Show. Right, looking at futures, we've now actually picked up slightly more momentum to the downside, 0.25% now on the A50 contract here in Hong Kong, slightly less on the similar contract, of course, over in Singapore. We should be getting the fixer today in about 3 minutes, more on that in a moment, 7:30 right now. But all things said, our focus is on the CGB market following what the PBOC did yesterday, stopping this rally in its tracks. Sorting the broader story, though, when you look at bond markets, is the complete opposite of what we're seeing in the CGB market, with yields continuing to melt up. Globally, we're up 3 days on global yields. Treasuries are coming off the worst 2 days going back to April. Let's see where we go from here on all things markets. Geoffrey Lunt is with us here on set, head of Asia Investment Specialist at HSBC Asset Management. Jeff, it's nice to see you, sir.
You too, David.
The notion that Trump 2.0 is bad for treasuries, your thoughts on that?
I think that's clearly the market narrative. That's why we've seen a little bit of a sell-off on in the Treasury market. But let's face it, it's a fairly volatile situation anyway. And I mean, and it feels very volatile, these 10 basis points move in a day. But I think that the medium to long term is probably not going to make all that much difference in relation to what investors need to think about in order to set their long-term asset allocations.
Which are? What considerations, yeah?
Yeah, absolutely. Well, bonds, we believe, are still very good value. The all-in yield that you get from spread product is still attractive, despite those spreads being quite narrow. And so from that perspective, I think incidents like this, which are essentially politically inspired, probably give asset allocators a good long-term entry point into markets such as US bonds.
So, Jeff, Steve Engle, I'm jumping in here. So what do the numbers tell you about what the Fed might or might not do and when?
Well, I think, again, this is a time to take stock. I think that the general direction of the economy and markets were in line pretty much with what we were expecting, and that's a disinflationary course, but for inflation not to fall back to target too quickly. And from that point of view, as a bond investor, then I'm not that concerned that we're not seeing dramatic collapses in yield. I'm actually very happy to be able to invest at these higher rates, which I think will maintain for a little while to come until we get greater visibility on what the Fed is going to do. I mean, if you remember, in the first few months of this year, we were very, very taken by the fact that inflation numbers were a little bit higher or stickier, I think the market uses the term. Now, perhaps things are beginning to ease back again. Some of the, obviously, activity data has become a little bit softer. So I think that we're still on course for Fed cuts in this year, but it's still going to be quite a gradual process.
So September, December, or into the next year? When would the first cut be?
Well, we would say September, but I would implore investors not to get too hung up with the exact timing.
Well, agnostics say on a month-to-month basis, do you think this preference for dollar assets continues? The strength in the dollar continues to dominate proceedings?
Yeah, well, I do think that the bond market is part of that story, obviously. I think that the situation that the yen is in, and we were thinking about this just last week in the context of the euro. There are all sorts of reasons why the euro might be a little bit weaker. Obviously, we have some quite interesting political items on the agenda as soon as this week. And then when you look at the yen, you still obviously have a very significant yield discount if you invest in JGBs, and perhaps the market had got a little bit carried away by the normalization of the Japanese rate situation. And that encouraged quite a move into the yen, which is now beginning to unwind. So I think that there are essentially fundamental reasons why the dollar remains strong, particularly against those amongst the constellation of those G3 currencies.
So while we're still talking US dollar, and also Fed, how would you position yourself into the second half of the year as we are now? Can't believe this year's gone by so fast. But for the stock move, I mean, the S&P has been near record highs. We have this AI boom. Do you expect this to continue through the rest of the year?
Of course, everybody is so well aware of the fact that the stock market rally in some periods has been very, very narrow, and we're always looking for it to broaden out, both in terms of geography and also in terms of the sectoral performance. But in that sense, I think that it does encourage a degree of caution. But it doesn't, I think, it isn't enough to really derail the overall momentum of global stock markets, and therefore taking positions which are close to neutral, but perhaps with some bottom-up and sectoral positioning is the way to go. So, in essence, I think that we'll be quite neutral of global equities, with some nuance within that, but also overweight duration.
Okay, well, quickly then. So, do I lean into AI? Do I fade that rally? Because that's a question. And I'm going to stop short of naming names, NVIDIA, but yeah, go ahead.
Well, I think it's dangerous. Perhaps, you know, I could draw the analogy with the yen. It's quite dangerous to take significant positions in these in these elements of the market, which have become quite or so volatile. I mean, when you can lose
all sense
tens
of time.
Percentage points in a single day on a single stock or a single currency position, then perhaps that you might want to take your risk elsewhere from these themes.
Okay, well, and we'll talk about elsewhere in a moment. Jeff Lunt, of course, stays with us. Maybe we'll talk China, India, and maybe everything in between there. Out of HSBC Asset Management there. Okay, very quickly here, the fix of the day is out. You're looking at a midpoint just under 713. That's 1.3 against the US dollar, 712.91 there. If you're curious on the specific level, futures are now flat going into this open. Today we are on correction watch here in Hong Kong, of course. Plenty more ahead here on the China Show.
The American people must decide that Trump's embrace of violence to preserve his power is acceptable. Perhaps most importantly, the American people must decide they want to entrust the president once again, the presidency, to Donald Trump, now knowing he'll be even more emboldened to do whatever he pleases whenever he wants to do it. No one is above the law, not even the President of the United States.
And that was President Biden there speaking after the U.S. Supreme Court ruled that presidents do have some immunity for official acts. That decision could, of course, mean a criminal trial over Donald Trump's alleged attempt to overturn the recent elections. 2020 is delayed for about a year or more. Bruce Einhorn joins us right now to talk us through the intricacies of this and what exactly this might mean. One is partially immune. to criminal liability.
So the court in the 6-3 decision ruled that there is a distinction that has to be made between official acts and unofficial acts. And so the court's majority says that something that the president does as an official act as president, that is immune. The question is, what's official act, what's an unofficial act? So the court is now saying this is remanded back down to the district court, and the judge then will have to have hearings to determine whether the things that are in the indictment count as official acts or unofficial acts. So that's going to, of course, take a lot of time.
So this is a foregone conclusion that it could be delayed well past the election. And if we can, kind of extrapolate even further, if he is re-elected, after January, when he's inaugurated, he could potentially appoint his own attorney general to throw these cases out.
Well, I think potentially you don't really need to use that word. Obviously, he'll do that. But let's take a step back for a minute, because yes, there won't be it's almost impossible, I think, that there will be a trial with a jury anytime this year, maybe not even next year. However, because the court has said that the district court now needs to determine what are official acts, what are unofficial acts, there will need to be proceedings in court. And so that will give an opportunity for Jack Smith, the special prosecutor, special counsel, to present evidence in court. So it's not like this goes away. This is still there, and the things will still be happening. There will be opportunities for people to see what some of the evidence is, and there won't be a full-fledged trial before the election, but there will be some sort of public airing of some of these charges.
Right. Bruce, fantastic. Thank you so much. Bruce Einhorn there on the latest there with Donald Trump. Just to borrow a legal phrasing here. Correction, Your Honor. Correction is what we're watching as we approach this reopen in Hong Kong. In fact, at this specific level you're trading at on the Hang Seng Index in the opening few minutes, 17,669 effectively takes that 9.8% drop from May 20 up into the Friday close, now at about the 10% level. So we are set to enter a correction, if all things, of course, don't change going into the rest of the trading session here. Right, in fact, a specific level right now, there you go, 17,669. We are poised to open lower at this reopen today. Very quickly, away from the equity markets, bonds still very much in focus here, 135 and I believe 10 and 30 on the CGB curve. There we go, we're down again. Just about across the board, although that is a very marginal move given the roller coaster and whipsaw we saw yesterday. We were as low as 2.18% on the 10-year before we sort of retraced all the way back to about these levels right now. Right, a couple of sectors to watch. EVs, so you have a lot of names here. So BYD reporting, and these are June sales numbers, effectively, what we're talking about here. BYD record. NIO also came out with theirs, Xpeng, and Geely Auto, 4.8% to the upside. Also, in their specific case, they revised their guidance upward as well. So that's what you get when that happens. Casino stocks on the back of data coming out yesterday. We'll unpack those numbers also in a moment. Plus, of course, the opening bell just over 3 minutes away. And futures are pointing to the downside here. Just keep in mind, onshore, we are on track, though, to snap a 2-day winning streak. There we go. Good morning, Hong Kong. This is the China Show. Okay, just approaching the opening bell. Here in Hong Kong, the reopen, of course, we were shut yesterday for the marking of the 27th anniversary of the handover. And, of course, onshore, we are on a 2-day win streak. We're looking poised to open lower. A couple of minutes as well we have RBA minutes coming through. This is for the June policy meeting, so stay tuned for headlines coming out of that. And I forgot to mention at the top of the show, we also got some inflation numbers coming out of Korea. So the month-on-month headline print actually came in not only much lower than forecast, actually came in negative. So it was the first negative month-on-month print in Korea going back to November of last year, the second steepest drop in the last 4 years or so. And I'm hoping for maybe, if you're looking for inflation to come in the U.S. at least, according to script, what do you call it? Is it called a gauche reaction, is that what they call it, right? When X starts to mimic Y. Anyway, that's for another conversation. 0.1% to the downside on the CSI 300. I'm not looking at equity markets very closely. It's the bond markets where really a lot of the news flow has been. And I'm looking at the 1-year yield lower, 10-year yield is slightly lower there as well, very much in focus after that whipsaw on Monday. Okay, let's flip the boards, please, and have a look at the reopening here in Hong Kong. We are on correction watch, and the level you want to watch is right below, give or take, it's at about 17,700 or slightly below that level. Under which we will be entering this technical correction that's about 10%, of course, from on a closing basis from a recent peak, which was, in this case, May 20. Weakness coming through across most of the big tech plays as well. HSBC on your screens at 10.1%. In a couple of minutes, HSBC is going to come back on your screens. Very, very quickly, a couple of movers to tell you about here. So we'll talk more about the EV story in a moment. June deliveries out, BYD at a record. MGM, by the way, and speaking of casinos, numbers out yesterday at about lunch. I think these markets had already reacted to that. And as I had erroneously alluded to a few seconds too early, EV stocks in focus. I think Geely should be bottom of your screens. In the pre-markets of 5%, we're up now just about 3% right now. So BYD record, a beat on some, not all. And of course, in Geely's case, they also needed to upgrade their guidance for 2024. There we go. Thank you so much on the strong sales performance. Right. Is this indicative of a market that is seeing an earnings story start to turn around? As we bring in Jeff Lunt, we'll talk more about the RBA minutes in a moment here in the bottom of your screens in case you want to see some of the takeaways there. Jeff, let's talk about China. What are you guys telling your clients?
I think that we want them to concentrate on a sectoral position in China. We're taking a barbell strategy, in fact, taking some defensive stocks, but also some more aggressive positions in sectors such as autos and in the Macau complex, which, as you know, is mainly a leisure sector.
Yeah.
And in that way, I think that it's incredibly difficult to definitively declare the turn, both in the economy and in the market. And so concentrating on those areas where we have the most confidence that the market will do better than the average, I think that is the way that we're approaching it at the moment, because we can all claim that we're on the verge of an upturn, but at the same time having real confidence that we absolutely know that now is the time is obviously a difficult thing to do.
Is that a bet on the consumer? Because consumer confidence has been very weak, and there's been no indication that the Chinese are ready to necessarily fork out. I know Danny Lee, who's sitting here to my right, he's going to talk about people are going into EVs and they're buying, but there's a price war. There's discounts going on, and they're sacrificing profitability. We'll talk about that in a second. But if you're looking at the investment strategy going to Macau, going into certain consumption products, that means you think there's going to be an uptick in consumption?
Well, not necessarily, and that's where the sort of barbell strategy comes in, because we are selective within that consumer space, but also we are barbelled in those more defensive areas as well. So it's where we have the bottom-up confidence, both in the sector and the individual stocks, where we really want to add value to our portfolio. So it is often about actually not making a call on the economy, because one can have greater confidence when you know the companies very well from a bottom-up basis, that you can better modulate the risk-adjusted returns that you get either from an equity portfolio or indeed a multi-asset portfolio.
You started the answer earlier on by saying we hope to sort of convey to clients that this is maybe an entry point for a longer term portfolio. Are they receptive to the idea is my follow-up question to that.
I think that the simple answer to that at the moment is no. We are seeing some greater interest, but all through this period of the economic volatility in China, we have seen our clients all over the world absolutely focused on the story, but at the same time not putting money to work yet.
Okay.
So again, this tipping point, at the point at which there is global investor confidence that the Chinese market and the economy has turned the corner, I don't think we're there yet. But at the same time, it is up to us to keep on conveying the narrative, what is happening. And it is not in our interest or our clients' interest, obviously, to just be implausibly optimistic about the situation for the market. It will come back. Markets do. But we don't know exactly when.
Do you think the third plenum, which will be happening exactly 2 weeks from right now, can be a panacea for a lot of these ills in the Chinese economy, whether we get big bang supportive policies or it's more long-term structural changes?
Simple answer again, no. It won't be the panacea. It will give us some long-term direction for for Chinese economic policy, but that's not really what this meeting is for. The big bang, short-term policy bazookas, that's not what this meeting is for. As I say, this meeting is for longer-term setting out of economic strategy and policy. So yes, it's something that I think that people try to hook the narrative onto these big political events. Yes, absolutely. But whether that will result in a market disappointment, I honestly don't know. But if though people are expecting it to be some huge policy announcement that's really going to change the direction, then that is likely to be disappointed.
Jeff, just final question going into the second half, and just broaden out the view. Cross-asset, global, biggest underappreciated risk out there. What's the pain
biggest
trade?
Underappreciated risk? Well, I think that what I hear all the time is phrases like unusually uncertain, that the outlook is opaque, that there is a lot of risk around, political risk. Perhaps the greatest risk in terms of underappreciation might be to actually be a bit more bullish about everything.
Okay.
About credit spreads, about duration, about equities. Perhaps we won't have these flashpoints which will take markets to much lower levels, because I still think there is excessive caution in positioning at the moment, and so I think that the big risk might be to be too short.
Why worry too much, according to Jeff? Why worry too much? Life is short. Jeff Lunt, fantastic. Thank you so much, Head of Asia Investment Specialist at HSBC Asset Management. Right, going into the first, 8 minutes of the show, we're looking, just glancing at some of these EV plays. BYD down, the rest of the pool moving side to the upside there. So BYD actually selling a record number of EVs and hybrids. You combine that and you get a figure that's a record for the second quarter. You have discounts, though, boosting, and also new technology. Let's bring in Danny Lee, our Asia transport reporter, on how good these numbers, put this into context for us.
Yeah, they're just close to 1 million unit sales in the quarter, which is their best ever, and coming off the back of a slow start to the year. So across the sector, we've seen robust numbers. Some peers hitting records, but no one sells as close to as many as BYD does. So they really do dominate the market. But again, everyone's having to wield these price cuts in order to stimulate the market.
What does this tell you about the overall health of the market? Because they can drive their margins down, their profitability suffers, but they have such scale, and 33% of the EV market in China, so 1/3. They could potentially be the world's biggest EV seller as well. If global markets have challenges. But what does this mean for all the other smaller players?
It just shows how much the others have to fight to compete on price, how much they have to invest to upgrade, because BYD has such a dominant position in the scale now that they overwhelm the market. And maybe this is part of the concern when you look at how EV players like BYD are going abroad very quickly in order to dominate and to replicate the success they have at home in China, the biggest EV market, the biggest auto market, and to try and do it all abroad.
Danny Lee, thank you so much. Unpacking that story for us on the sector-specific story. Our Asia transport reporter there. From one sector to another, casino stocks. We did get the numbers for June. Slowdown in the business. Overall, there's obviously some critical nuance there. Lack of holidays, long holidays, that's number one. You have cautious sentiment still, obviously, is the pervading sort of narrative there. Let's bring in Angela Han Lee, our Bloomberg Intelligence senior research analyst, to talk us through at least what her thesis is behind why we did get that weaker than expected gaming intake.
There could be two reasons. The first one, which people mention more, is about the Beijing's crackdown on money flow from in China to other countries. But I think what more importantly could be the Macau casino stopped giving out a lot of freebies.
Yeah.
So you know that they have been giving a lot of free bubble teas and free snacks to keep people coming in.
Yeah.
And then Macau government was concerned because the small and medium-sized enterprises outside casinos are losing business because casinos are giving too much free stuff. So that became something like, you can only give those free things to people if they are gambling or doing something else, not just because they just want to come in for free stuff. So I think that can be cause the slowdown in the casino traffic. Then you feel like less people, the casino floor is less crowded. Then you don't feel like you want to stay longer.
Yeah.
So I think that was the reason why it can be having some a weakness in the gaming revenue.
Okay.
But I just see the June number was weak, but it wasn't really that weak. So I think we have to pay more attention on the July numbers and later.
Well, that's what I was going to say, because June is traditionally weak, because May is the Golden Week holiday.
Yeah.
June kind of a dip down. So how important, and what are we expecting going forward as it aligns with policy, as it aligns with big-ticket spenders? What do you see for the second half of the year?
Our numbers are kind of in line with market expectations, but we are going to see some slowdown in terms of year-over-year growth. I think July gaming revenue could be up 15% compared to 24% growth in the second quarter of this year, just because the base is going up. Say the last year, the casino operators became fully operational in the middle of last year because they were suffering from labor shortage. So they opened casinos in the first quarter after reopening, but they were still struggling with opening the restaurants and other outlets. So they turned fully operational in the middle of last year. So we are going to see some a base normalize from second half of last year. So for that reason, we are going to see slowdown in year-on-year growth. But I think the numbers should be still strong, and we are expecting the gaming revenue to reach at least 75% of pre-pandemic levels this year.
What are you seeing on per capita spending and the notion that people are not spending as much per capita?
So if we separate a VIP gaming and the mass gaming, for mass side, I think we are still seeing okay. But the VIP segment, of course, is not doing that well. And we are also seeing some weakness going forward, in casino markets in other countries like the Philippines too. So I think in terms of the overall per capita is declining. But if we talk about the mass gaming, I think it's still kind of really solid. But I think this time it was more about the gaming, market share gain story. So you see the Galaxy and Macau share price was down less than other operators in June, which was kind of similar in May as well. So I think Galaxy and Macau, this type of operators who had new casinos last year, are obviously trying to see, we are seeing some signs that they are gaining share this year. So I think this could be something that maybe investors want to pay more attention to.
Okay,
yeah.
So new online and new offerings. Angela Huntley, fantastic. Thank you so much. Our senior research analyst at Bloomberg Intelligence here. Okay, RBA minutes are out. This is for the June meeting. Okay, we're just trying to pick out what is, they're all relevant, to be clear. What is more relevant, the others, I guess, is more important here. There is, number one, the economic path is consistent with the CPI return to target in 2 years. They've said it before. It's difficult to rule out in or out future cash rate changes without a reference, by the way, again, without a reference to the direction of that change. It's worth keeping in mind, right? So you had an RBA meeting, then you had an inflation report which changed betting and expectations around future RBA meetings. So August is certainly live. September was base case as far as a hike is concerned. So just more context there. Aussie dollar, though, holding on to declines after those numbers, and those lines, of course, broke. Okay, we'll leave that there for now. And up ahead, of course, a market wrap of what we're seeing so far across these markets. 15 minutes into the cash market session on the mainland and here at this reopen in Hong Kong. This is the China Show. Welcome back. You're watching the China Show. A look at Sydney, of course, this morning, question mark. Are we at noon now? Okay, I forget what time of the year, when we are in the year and what the clocks are. Oh, there we go, 15 minutes to noon. There we go. Sounds like a movie, doesn't it? Okay, anyway, let's talk about nuclear power there. Australia's opposition to the Liberal National Coalition is promising to build the country's first nuclear reactor if it wins next year's election. And they say that the plan will deliver cheap, clean, reliable electricity, but the Albanese government is dismissing the idea, or Paul Allen explains.
Of all Australia's mineral riches, perhaps the most underused is uranium. About 1/3 of the world's reserves are here. Despite the abundance, Boss Energy is one of just 3 companies producing uranium, and all of it is exported. The country's opposition Liberal Party wants to change that, with a plan to build up to 7 reactors on former coal-fired power station plants to ensure energy security.
I'm very happy for the election to be a referendum on energy, on nuclear, on power prices, on lights going out, on who has a sustainable pathway for our country going forward.
There's no shortage of barriers to nuclear energy in Australia. Forget community resistance. Nuclear power is currently illegal, banned by a 1999 Act of Parliament. Assuming the law gets changed, there's still the issue of cost effectiveness. Major generators like AGL and Origin aren't eager to spend on nuclear.
If things go wrong, they can go very wrong, which is why modern nuclear facilities are built with safety in mind. And this can make them expensive. They can also be even more expensive if they're being built in markets that don't have experience in constructing nuclear power or nuclear supply chains, where there isn't supportive regulation, policies or politics, or where there might be legal challenges. And unfortunately, Australia faces all of those hurdles.
And then there's time. Even if the other hurdles are overcome, it would be 20 years before the reactors would be supplying electricity, a much slower rollout than renewables.
We know that Mr Dutton wants to slow down the rollout of renewables, and he wants to introduce the most expensive form of energy that's slow to build. But today, we've seen no costs, we've seen no gigawatts, we've seen no detail. This is a joke.
Australia does have one operational nuclear reactor, this research facility at Lucas Heights on the outskirts of Sydney. It mainly produces cancer medication. At this stage of the nuclear debate, it seems unlikely to be joined by any more.
And that was Paul Allen there explaining this, the conundrum, let's put it that way. Okay, if you are one of our Bloomberg subscribers here, you can check out all the interviews you might have missed, including that story, of course, that Paul just laid out. Our interactive TV function, TV Go, catch a conversation, join what we talk about here in shows. For our clients, of course, you know how to reach us anytime, of course. Whether or not we respond in kind is another question altogether. We will try our best, of course, to be good sports. Let's put it that way. Check it out. TV Go. Markets looking like this. This is Bloomberg. Here's some other corporate stories we're tracking this hour. Singapore is lowering the threshold for checks on cash deposits received by casinos in a bid here to prevent exploitation by terrorist and criminal organizations. Now, the new rule will effectively require casino operators to conduct due diligence checks on deposits of 4,000 Singapore dollars. The current level is at 5,000, of course. Okay. Now, Reuters is reporting that China Construction Bank is slashing pay for employees at its headquarters by at least 10%. So we're talking about high-ranking officials will reportedly take in steeper cuts in salaries as a lender tries to reduce their costs. Pay cuts at CCB subsidiaries have so far been deeper than those taken by staff at its headquarters. Now, shares of Paramount jumped in extended trading in New York, as you can see on your screens. It's after a New York Times report that billionaire Barry Diller is exploring a potential takeover bid. Now, his digital media conglomerate IAC has reportedly signed non-disclosure agreements with Paramount's controlling shareholder, National Amusements. Now, Diller's interest comes after Skydance's takeover bid fell through. Now, China is planning this broader push, and this is going to get interesting, I guarantee you guys, is planning this broader push to develop technology around brain-computer interfaces. So this is the kind of technology being developed in the West by companies you might have known and heard, the company of Elon Musk, Neuralink. Now, Beijing's Industry and IT Ministry says it plans to assemble this committee of industrial and technical experts. They'll be asked to come up with standards for errors, including brain information encoding and decoding, and also data visualization. And now to visualize the story in the market context, you have, by the way, we didn't know up until today, at least I didn't know, that there is a sector of this market, brain interface stocks, are seeing some substantial upside on the back of this plan that was outlined there. So you are seeing gains in the order of about 3 to 6%. And this is just a small sample size, of course, of that broader investment universe as well. So if you want to get more, of course, on this specific story, we have a fantastic write-up on the Bloomberg right now, and that's not a pitch. You can read about it. It's a fantastic piece there as well. Check that out. One specific group of stocks today that's really seeing a lot of volume come through, a lot of price action. We'll see, of course, whether or not this continues to last. Okay. Pivot away from equity markets. We're looking at U.S. Treasuries and how the curve looks like now following the melt up in yields from Friday. Big move up on Friday, big move up yesterday. We're steady and we're trading sideways in the Asia goings. We'll see what happens when London opens up, of course. And traders are effectively weighing in what a Trump 2.0 might actually mean. Higher inflation, more reflation. Certainly, if you forget, right, 8 years ago, that was a conversation when he came back to the office, into office. And obviously, we saw that in the equity market as well. Right. What this means for bonds in the risk region, though, and when you look at some of these yields coming through as well. So in the next hour of the China show, we'll be joined by CreditSights, of course. Zerlina Zeng will be talking us through their credit strategies amidst very tight spreads and where they still think risk-reward is still doable there when you look at the credit markets. A look at China, 30 minutes into the session, plenty more ahead. This is the China Show. Welcome to the second hour of the China Show. Half an hour to the session here in Hong Kong. We're up 1.3%. So on price, we're doing very well. H-shares are also doing quite well, 1.5%. So we're pulling back from the brink of this. At one point, flirting with a technical correction. Certainly, that's a conversation that is slightly more distant than it was 30 minutes ago. Volumes are coming through as well. Might have to the fact that, of course, we were shut yesterday, so there might be some pent-up buying taking place today. That's number one. Number two, a couple of things this hour. I believe John Lee, the chief executive, is still speaking in his weekly address. We'll bring you any headlines that come through from there. The other big item on the agenda today in Hong Kong, well, two other things. One is this hour, of course, Segantii hearing. I believe Simon Sadler just showed up in court. More on that in a moment. Also, we have retail sales coming out of the city in terms of data coming through. So lots on the agenda today. As far as the big movers go, so the bottom row on your screens, those are the heaviest weighted stocks of the Hang Seng Index. Everything is on the way up. Tencent, plus your big financials on the way up. There's a Reuters report, in case you missed it a few minutes ago, that China Construction Bank is, at its headquarters, is cutting pay by about 10%. If you're a high-ranking official, then I think you are in store for deeper cuts. More on that, I guess, also in a moment there. Speaking of Chinese banks, really part of this bond story that's really come together quite quickly. And Steve, I know you have you can chime in on this too. The PBOC had to come in and bring one of the tools it doesn't normally use, this fresh toolkit to maybe alleviate some of the upward pressure we're seeing in the bond markets.
Yeah, and this will be interesting to see how effective it is. And it's something that was sparked the speculation of market watchers a couple of months ago when Xi Jinping did mention in a speech, and we do track his words quite closely, and to see how that relates to policy and getting the PBOC to essentially intervene in the bond market to kind of stop this rally.
Send a strong signal.
What?
Send a strong signal.
Send a strong signal, absolutely. But you have to see how it's going to be implemented and what is going to be the efficacy, especially a couple of weeks ahead of the plenum meeting, which will, of course, tackle longer-term stresses in the economy. But again, they're facing extreme short-term pressures right now on multiple fronts. And really, what we're seeing in the CGBs is really a reflection of the overall weakness in the Chinese economy.
And the lack of inflation there. Yeah, and to your point, right, they really have to come in and push against the fact that inflation is going to come back in China and come back in a very big way. And of course, holding bonds at these levels is perhaps a big risk if and when that happens. Interesting enough, what happens here in terms of valuations, because we are getting a lot more Chinese corporates, by the way, in the offshore market. Just a case in point, right? Meituan coming in. And looking to tap the bond markets here in Hong Kong. We've talked in the past several weeks of convertibles. Alibaba, and what that means. Maybe it's a time. With spreads this tight and borrowing costs is low, it might be time to do just that. In fact, Asia ex-China, and how we're doing across these equity markets, though. One group of stocks, by the way, which we'll talk more about this later on in the show. A lot of these movers in Korea are moving up on the back of this. More details on the value up program. So I think Korea, 0.6 of 1% to the downside, although you are getting, I think it's the car makers, if not mistaken, seeing some upside here. I'll correct myself if I'm wrong. More on that in a moment. Dollar yen, 161.60. Again, against the US dollar. Broadly, dollar strength coming through here. And Steve is just nodding, just shaking his head.
Well, I think, Jeff was talking about it a little bit. It's very difficult right now. You would think that the yen would start strengthening, and that's what the bets had been, but it keeps on getting weaker, despite the signals that the Fed is going to be cutting, perhaps, as Jeff said, as early as September. But the yen is really being absolutely pummeled right now, 161 and change, with no indication as of yet that the Ministry of Finance is going to be stepping in. But they stepped in, what, a couple of months ago, and we're right back at these levels of 161.
Here we still are.
Here we are.
Yeah. It would be hard to imagine, though, where we would be if they hadn't stepped in. Anecdotally, of course, if you over-obsess over social media like I do on boring days, on weekends, I mean, my feed was inundated with just extreme pictures of extremely long lines going in these Japanese airports, of tourists flooding into the city because of the weak Japanese yen.
Careful, though. They're talking already about charging foreigners higher prices because of the extremely weak yen, so...
Yeah. The other angle here, too, is, what is this doing to outbound tourism in Japan? And what is it doing to also, as Japanese markets come back, how are we going to attract top talent and be able to pay them and compensate them well with a currency this week and taxes that high? Anyway, that's for a different conversation. Yep. Now back to this bond market and what this means for credit strategy. Joining us now is Zerlina Zeng, head of Asia Credit Strategy, East Asia Corporates at CreditSights. Zerlina, well, first and foremost, congratulations on the new post. We'll certainly have a lot of time to talk about strategy in a moment, but I want to get your initial thoughts on, and I'm sure you're following the story in China of falling bond yields. I know you don't cover CGBs directly, but from your perspective, do you think this feels like a bubble in the CGB market?
I personally don't think it is a bubble, and the PBOC's verbal intervention, it's actually not a surprise. The central bank has been voicing out some of the warnings against an over-concentration of allocation by the non-bank financial institutions into the long and CGB. But the fact is, right now, the credit demand is very weak in China, and a lot of the financial institutions are still looking for long-dated opportunities in terms of their asset allocation, and the demand is still there. I think, as you mentioned, the market is closely watching the effectiveness of this central bank intervention. But the fact is, the PBOC, they actually does not own that many of long-dated CGBs. So I think it will be quite short-lived. The market is still looking for a buying opportunity of this. And I think another angle is for US dollar-denominated foreign investors. If they hedge the FX using a forward 3-month forward rolling, it actually generates a quite attractive yield against the U.S. Treasuries. And this has been one of our recommendations over the past 2 months, and the trade worked quite well. So personally, I think there are still going to be continued inflow into the onshore CGB market.
Fantastic there. Okay, so what does that then mean for, as yields continue to tick lower? How has that affected fundamental analysis from your perspective? Because spreads have also been coming in very, very tight there. Where do you think we are in valuations? Onshore.
Yeah, I think maybe deep down the PBOC has this bias to manage the long end of the CGB curve lower, because this is the anchor for a lot of the local governments special purpose bond and general purpose bond issuance. And the deposit rate is also supposed to be to some extent anchored towards the long end of the CGB. So from a policy setting point of view, they do have some bias to manage down the interest cost for both the local government debt as well as the banks. And we know the banks are already facing a lot of minimum margin. So this is a way to manage the cost to also, set up a bit more capital space for the bank to extending credit to the real economy.
Zerlina, where are you looking in the corporate space? I mean, oftentimes, of course, we do get the news flow comes out of the high yield space, in particular property, but we're not out of the woods on the property space yet, are we?
No, we're not. If you look at the dollar bond high yield market, indeed, year to date, we had a very good performance compared with the US, Euro, and emerging market credit markets. The China high yield actually outperformed. But I think most of this performance was driven by the high yield industrial sector. So basically, right now, the market interpretation is the default rate of the high yield property developers is coming down compared to the past 12 to 24 months. But this is not a resolved issue. We are going to still wait for very long in terms of debt restructuring, and the recovery is very minimal. But the point here is the contagion to the non-property segment is very much contained. So the people is looking for the high-yield industrial, Chinese industrial credits with relatively attractive coupon for carry. And I think other Asian high-yield segments such as Indian renewables, Macau gaming, overall the credit stance has been quite strong. So as a result, investors are quite interested in the space. But I guess going forward, once the U.S. Treasury yields are coming down a bit and the all-in yield for Asian credits might also come down, I think the investors might adopt a more defensive stance moving into the second half of the year.
Right, and just to build on that, Zerlina, for those investors who are conservative, that don't maybe share an optimistic view of the world, don't trust a lot of people, what options are there for defensives at this point, particularly on the sort of high end of the quality spectrum?
Yeah, within the high end of the spectrum, year to date, we have seen a lot of diversification-related flow into the Korea corporate bond space. So this is the dollar bonds issued by the Korean corporates, including both the quasi-sovereigns as well as some of the BBB rated names, SK Hynix riding on the AI upcycle, as well as some of the EV battery chain makers. A lot of credit investors in Asia are also diversifying into off-index positions in the Japanese and Australian financials, and some of them are looking outward into the European and U.S. investment grade market. I think the dilemma here is we don't have that many new issues coming from the Asian dollar primary market, and the secondary market valuation has getting more and more expensive. So any downside risk, such as U.S. election, European political risk, could put the spread at quite a vulnerable position. So diversification, in our review, is quite key in terms of the Asian credit strategy.
Right, and what options are there given how tight things are? What would your recommendation be? How far up the duration ladder I need to go then at this point?
Yeah, so for duration, we are still recommending a barbell strategy. So at the front end, we're looking for the on-the-run new issues coupons, which tend to be much higher than the existing secondary market. And then we are recommending extending duration just a bit into the 7 to 10 year part of the curve. We are still looking for about the 325 basis point cut from the Fed. So for long-term focused investors and from a total return perspective, it's still quite attractive to holding on to this higher yielding assets.
I need to ask you about India, the bond inclusion. I mean, slow train coming, and we saw that clearly from a mile away. Where do you think we go with that story from here?
Yeah, I think this is a quite exciting market for a lot of the Asian credit investors. Given the dollar bond market right now, supply is very limited. Investors are indeed looking into the local currency bond market. To some extent, the market might have already priced in this inflow because since the announcement, there has been more than 10 billion of inflow into the Indian local currency bond market. But I would expect, given the quite solid macro fundamentals, fiscal consolidation, as well as the quite stable currency on the Indian rupee, there will be continued inflow into the market at the range of maybe 30 to 40 billion of US dollar, gradually phasing in every month. So this is still quite a bullish market in our view.
Zerlina Zeng, thank you so much for joining us, Head of Asia Credit Strategy and East Asia Corporates there at CreditSights in Singapore for us. Right, so from Singapore, we'll take you now to a live look and some live pictures right now out of a courthouse here in Hong Kong. Clearly in Wan Chai, as you can see there, of course, splattered on the building here. The trial, of course, of Segantii founder Simon Sadler is underway currently. We'll have more on the story later on the show. Also on the show and coming up here on the China Show, traders weigh the possibility of another Trump presidency as the Supreme Court rules he has some immunity from criminal charges over that's what happened in January 6th. A closer look at the market impact, and as you can see where yields are, perhaps is already a part of that conversation. This is Bloomberg.
The American people must decide that Trump's embrace of violence to preserve his power is acceptable. Perhaps most importantly, the American people must decide they want to entrust the president once again, the presidency, to Donald Trump, now knowing he'll be even more emboldened to do whatever he pleases whenever he wants to do it. No one is above the law, not even the President of the United States.
And that was President Biden speaking earlier in reaction to the Supreme Court decision on Donald Trump. Now, JP Morgan Asset Management's chief global strategist is warning of possible U.S. stagflation if Republicans pull off an election sweep come November. David Kelly told us how Donald Trump's policies could disrupt the rhythm of the U.S. economy.
It's kind of like this very stable machine that sort of just pumps out twos in terms of growth and inflation. Well, what could change that is, something will change it. A, a shock, or B, a big policy change. I mean, we're just talking about, I do think that what happened on Thursday meaningfully increases the likelihood of a Republican sweep in November. If Joe Biden is the candidate, it's quite possible a lot of independents will stay at home, and so Republicans will sweep. Now, if they sweep, if you take Donald Trump at his word, you've got much higher tariffs. And now tariffs are a elixir for stagflation. Tariffs slow growth and push up inflation at the same time. If you took him at his word on immigration, the economy would come to a halt because of deportation of unregistered immigrants or illegal immigrants. So, but I'm not sure if we can take him at his word. I think history suggests that perhaps it would be optimistic, or not optimistic, but it would be foolish to take him at his word in this stuff. But still, it's something to think about. I mean, some policy shock could absolutely tip this economy into recession.
Hold on a second. John said that basically Friday was the first day of this election cycle, at least for markets. How much do you actually rearrange what you think about how to position in markets as a response to this idea that you think that there is a greater likelihood of a Republican sweep?
It does make a difference. I mean, let me give you one example. The 2017 tax cuts. If Joe Biden is reelected, then some of those tax cuts will be extended beyond 25, but not all of them. If Donald Trump is elected, I expect that whole thing to go through. And if you add that to what the CBO is already looking at in terms of the growth in the debt as a share of GDP by the early 2030s is going to be about 135% as opposed to 122%. So you're going to have significantly more debt if we extend all these tax cuts, and that means a higher level of long-term interest rates.
So in other words, are you more bearish on long-term bonds right now than you were, say, Thursday morning?
Yes, I think it would be a rational thing to be that way. Yes.
And that was David Kelly, JP Morgan Asset Management Chief Global Strategist. Speaking, of course, that was Lisa, and of course also in shot was John Farrell there. Let's broaden the conversation. That's a JP Morgan Asset Management take. I would add to that, too, we were speaking with HSBC Asset Management about an hour back, and they think that markets are rational to think, to have that notion. You also have the likes of Goldman Sachs and Morgan Stanley also chiming in this fresh look at how perhaps a Trump victory could play out in the bond markets, and their specific strategies are now urging their clients to position for stickier inflation and higher, longer-term yields. Bad for bonds. Jill Deeses is here, of course, our news desk editor, to take us through the thinking here from a lot of those on Wall Street.
Yes, David, I actually think that what you just heard from JPM's Kelly there is in line with what we're seeing from a lot of other strategists as well. Morgan Stanley just had a note out over the weekend taking a look at the fact that, yes, the likelihood, this increased likelihood, or this, at least the perception of this increased likelihood that Trump may win in November has had strategists talk about this idea of stickier inflation. It's pushed up those longer-term yields a bit, particularly when it comes to those 30-year maturities. So I think that that's really what the market's positioning here. Because, look, I mean, we've known for many, many months now at this point that the idea behind a Republican sweep, or even just a Trump victory in November, would likely mean increased tariffs. Trump himself has floated this idea of sort of like a 10% blanket tariff across all types of goods there. So I mean, that's one thing that they're factoring in. And then also this idea that there could be significant reform in immigration policy. All of this kind of combines with that idea that maybe inflation is going to continue to persist a bit longer. And so I think that given Biden's really poor performance in that debate on Thursday, given some of this repositioning, the Supreme Court decision that just came out that makes it really unlikely that Trump is going to see any kind of trial or sort of court decisions around his involvement in the January 6th. I think that really is kind of making markets think, look, we're really swinging more toward this idea that Trump is going to win in November.
And that's really the key here, because again, it's still early in the campaign. There's still another 4 months. Well, some wouldn't say that that's too early, but again, he does tend to hype up certain policies on the campaign trail, then goes into office. But again, there's been this confluence of news, as you just mentioned, including the Supreme Court decision overnight, in addition to Friday's disastrous performance by Biden in the debate.
Yes, Steve. I mean, look, I think at the beginning of the year when, strategists, when investors are kind of laying out what does the landscape look like for this year, I mean, Trump certainly looked, somewhat likely to, maybe take victory in November. Obviously, this was an uncontested primary for the most part for him. But yes, I think even then, there was some talk about what's going to happen with those 2017 tax cuts that he implemented. Obviously, that's one of the big factors there, what's going to happen with tariffs. But even then, in the months since, we've even seen more clarity from Trump on some of those positions, including that 10% tariff idea that we're talking about. So yes, I think you take in combination this idea of several months of Trump really hammering home the point about tariffs and immigration being his two, biggest, strongest policies that he would want to implement in November, with a second term, and then you take that into account with this increased likelihood of a victory in November. That's really, I think, kind of throwing things into shock for markets a little bit and making them think, look, we're going to start charting this out as soon as possible.
Jill Deeses, thank you so much. Our news desk editor there, just laying out the plans out of Wall Street and the strategies as we perhaps look ahead to, let's just say, specific outcomes in November. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. Bloomberg has learned that Bridgewater Associates is launching a $2 billion fund that uses machine learning in its decision-making. Sources say the fund began trading Monday with capital for more than half a dozen clients, rather. Tuesday. Bear with me. We're told the hedge fund giant is leaning on its own tech, but the new fund will also broaden to include other models from OpenAI, Anthropic, and also Perplexity. Now, Northern Data is said to be considering a U.S. IPO of its combined AI cloud computing and data center businesses. The potential listing could fetch a valuation of as much as $16 billion, and it's targeting a debut on the NASDAQ perhaps as early as next year. Sources say Northern Data may also sell a minority stake in the unit to investors ahead of that listing, of course, early next year. Now, a fraud suit against stocks influencer, of course, on your screens, you know him, of course, has been dropped within days of its filing. A GameStop shareholder had accused Keith Gill, also known as Roaring Kitty, of engaging a pump and dump scheme. It's unclear why the suit was dropped. Now, Gill, of course, was one of the faces of the 2021 meme stock craze and reemerged in May with new posts about holdings in GameStop. Now, over here, this part of the world, China is planning this broader push to develop technology around brain-computer interfaces, and the kind of technology being developed in the West by companies including Neuralink of Elon Musk. Now, Beijing's Industry and ID Ministry says plans to assemble a committee of industrial and technical experts. They'll be asked to come up with things like standards for ARs, including brain information encoding and decoding, and also data visualization. It's playing out across markets. This specific story, an announcement yesterday on your screens. China brain interface stocks are seeing substantial upside against the backdrop of really a fairly muted market story, although we're up a third day, just to mention that, on an index level. Change the page, please. Look at Korean banks. Seeing some upside today on some of these tax incentive reports related to the Value Up program there. And as you can see, lenders are seeing upside in the order of about 2 to 5%. More on the Korea story later. This inflation number coming through earlier on. We'll unpack that and more ahead. This is Bloomberg. There we go. Just about under a minute away to the lunch break over in Tokyo, and markets are bids. We're at just about 40,000 and the Nikkei 225. The topics, of course, has outperformed. You might have seen that headline recently on the topics, effectively hitting a certain superlative. Let's put it that way. Speaking of superlatives, the Japanese yen keeps giving us headlines right now. So it's 161.58. We are, to borrow a phrase from the poet Axl Rose, it's knock, knock, knocking on heaven's door. 161.57 puts it extremely close to the highs that we've hit the last few days or so. And you have to go all the way back to 1986, actually before that Guns N' Roses album, for specific levels on dollar-yen like this. Yeah, so at 151.50, I think we have a graphic which shows you this over 5 days. And yeah, up and up and up we go. There we go. Extremely close to the highs on dollar-yen. It takes us into the broader market story across the region. By the way, it's a very good day to be long equity markets. We're up, I believe, a third day on the Asian benchmark. We're getting support across most sectors in the region, most markets on your screens, of course, as far as sector split is concerned. Apart from IT, you're getting some upside and good breadth across the majority of industry groups today. S&P futures are pulling down even further. And it's worth noting as well that we are getting some upside despite the strength coming through in the dollar and hence the yen conversation we just had just there earlier on. In terms of the Hong Kong and China story, onshore China, CSI 300 and Shanghai Composite, an hour into the session, are on track for a third day of gains. In Hong Kong, of course, we're reopening from the long weekend, and we are outperforming the benchmark today, up as much as 1.8% on the Hang Seng China gauge. Now, the other big story here in Hong Kong today, Segantii Capital management founder Simon Sadler and former trader Daniel La Rocca have arrived at a Hong Kong court where they are due to face insider dealing charges. Min Lo, our China correspondent, is here on set with us to talk us through the details on what we know so far. These are the live shot, of course, of that court where they are.
Yes, our reporters who are on site saw the CEO Kurt Ersoy also arriving together with the founder Simon Sadler. The other defendant, Daniel La Rocca, had arrived earlier. The court proceedings were supposed to begin at 10:15, but these guys are sharing the courtroom with 12 other cases in front of them. So as of now, we haven't heard any new details just yet. But I can tell you what we could expect. There are several scenarios that could unfold today. One is that the case may get adjourned if any of the parties request for an adjournment just to have more time to gather evidence to build their case, or the case could move forward. The defendants may be scheduled to enter their pleas. They may or may not do that today. If they plead not guilty, then there would be a trial, which would likely be set at a later date. But the critical thing about this is that it's held at the district court, and the district court can hand out longer sentences of up to 7 years as opposed to the 3 years that the magistrate's court can hand out. But the maximum penalty, though, for insider trading in China is 10 years. The other significant thing about holding this at a district court is that it has the highest conviction rate of all the different courts in Hong Kong, probably because it's decided by the judge with no jury.
Well, Min, can you boil it down into the significance of this particular case and the charges against them? You alluded to insider trading. The allegations, it ties back to a block trade with Esprit, but what is generally the significance of this for market participants who are watching this particular hedge fund and the collapse of it?
Yeah, so let me just walk you through the details of the case. It's related to a block trade in 2017 that was carried out by another firm called Lone Pine Capitals, according to our sources. And these three defendants, the firm, the founder, and that former trader, they're accused of insider trading ahead of that block trade in June 2017. They're accused of selling over 1.5 million shares of Esprit that they already owned, as well as short selling another 130,000 shares. So all in all, they sold about over $1.1 million worth of shares. And according to our Bloomberg terminal, we did see this unusual price movements in Esprit shares in the days around that block trade. You know, it's dropped 3% per day in a couple of days before the trade and plummeted 13% on the day of the trade. And all in all, Esprit really lost nearly a third of its value in 6 consecutive days around that trade.
It's suffice to say this case has garnered substantial attention here in Hong Kong. Talk to us about the significance of this case.
Yeah, so obviously if the SFC wins this case, it would really bolster their reputation as being a very strong enforcer of rules in the financial industry. And we know the SFC has really been trying to increase regulation when it comes to block trade. They've proposed to get the market sounding stage of block trading to be on the record. Now, market sounding is really a stage where banks, when they're trying to offload huge blocks of shares, they would often call up potential clients to gauge their interest to buy these shares, but obviously they cannot reveal the specifics of those trades because it contains market-moving information, and this is where potential leakage can occur. But sometimes it's possible to make educated guesses about these trades depending on the timing of those conversations, because many firms, especially newly listed companies, they have, typically a 6-month lockup period preventing shareholders from offloading huge blocks of shares. So banks do keep track of these expiry dates, and you can kind of guess sometimes what are the trades on the table. So the SFC has received some pushback from industry players who say that, these rules may make Hong Kong lose its edge among traders who may avoid executing cross-border trades in Hong Kong just because of the higher compliance costs. So the SFC has to tread carefully here, and banks will be watching this to see how they have to manage their relationships with clients in the future.
Sort of quickly, what is the time frame for the rest of this trial? The hearing is the next hearing is today. It's happening now.
Yeah, well, it's hard to say. It depends. Let me see if our colleagues, so they said it's about to start. We don't have any new developments, but we want to see what happens next and if they would announce a next trial date or another hearing date if it's adjourned. But look, this process could take months or perhaps years as well. If you look at other precedents in the past, it's taken more than a year sometimes for such cases to be concluded.
Min Lo, our China correspondent there, of course, ongoing as we speak here at a Hong Kong courts. Just a couple of minutes, of course, from where our office is here in central Hong Kong. By the way, an insider's guide to the money and people shaking up the finance hub is our Hong Kong edition newsletter. Just a tease for this, of course. Do sign up if you haven't already. Comes out Thursdays, and you can sign up, of course, on Bloomberg.com/newsletters. Okay, plenty more ahead here on the show. This is Bloomberg. It's here. Take it away. Right. Welcome to the show. So, an update on this Well, it's a data point which came out earlier, inflation rate out of Korea. And the reason it's fairly more significant than usual, it came in substantially below estimates almost across the board, although core was actually came in line with expectations. Now, certainly when you look at market reaction today, you do understand this came in outside the sort of possibility of expectations, or at least the sort of the center of the bell curve, as they say. So this is headline inflation. It's month on month. The yellow line is the median estimate, so we were expecting this to come in and still show a positive print, albeit 0.1%. It came in at negative 0.2. It's the first drop this year, first contraction this year, second biggest drop going back about 4 years. That's effectively pandemic level. So that's number one. Number two, our colleagues at Bloomberg Economics now think because of this weak CPI print, it now certainly opens the door for a rate cut coming out of Bank of Korea. The rapid slowdown in inflation will give the central bank more confidence to pivot towards rate cuts ahead. That's the headline takeaway from their initial report coming out of the headline CPI number. I mentioned market reaction. The South Korean won, dollar won on your screens. We had a look at the won against also all of its peers. We're weaker against the dollar. The won is also weaker against every single one of its major peers this Tuesday. So markets certainly readjusting their expectations on the back of this CPI print. Steve.
All right, Dave. Well, Samsung Electronics' largest union is planning a 3-day walkout starting next week, July 8th, as the latest wage negotiations have failed to yield any breakthroughs. Our tech reporter Annabelle Drulers joins us now. Now, I know there was a union members walked out for a single day back on June 7th. This is going to be tripling in size potentially next Monday. Give us the nuts and bolts of how we got here.
Yeah, well, it's quite exceptional, really, because as you say, there was that single-day strike last month, and up until that point, Samsung had never had a single strike in its 55-year company history. Of course, what's at the top of mind here for employees and the ones that are disgruntled relates to what is quite a universal phenomenon. It relates to pay. We can get to more on that in just a moment, but what you need to know now is really there's just a dispute that's going on between Samsung, its largest union at the company, which is the Samsung, or the National Samsung Electronics Union. It counts more than 28,000 workers in it. They've been trying to reach an accord on this. They've been going through lots of sort of stop-start negotiations. They've clearly broken down at this point, and now, as we know, the union is encouraging its members to join that strike action, as you said, starting the 8th. So that's Monday, Tuesday, Wednesday of next week.
Okay, so it involves pay. What exactly are we talking about?
It comes down to bonus payments. So these are really significant for Samsung employees. And, okay, Samsung, they're calculated by deducting the cost of capital from operating profit and then adjusting that for taxes on a cash basis.
Oh.
That sounds complicated.
That sounds
yes.
Okay.
If it's complicated, it's because it actually is just very complicated. Yeah. And so Samsung, the union, is urging the company just shift to operating profit, get in line with the rest of the peers. They're obviously not willing to do that. They're also just wanting them to be more transparent about how they go about determining the numbers. As I said, very important for them. This also really relates to the chip division in particular. These are the ones that missed out on bonus payments last year, given that unit posted a loss. Even if they do return to a profit this year, the union is concerned that workers still won't get that additional money.
Does this impact production?
That is not clear to us just yet. As you said, that one-day strike last month, it didn't really have much of a bearing, according to all fronts, the company, the union, also analysts as well. It really depends on how many employees ultimately elect to join the strike action. As I said, chip division workers are the most affected by this. They are making up the most workers at Samsung as a company, more than what you see in, say, the mobile or network divisions. Yes, it depends on really that, but the company as well, or the union rather, has signalled they're prepared to go even further from here. They've had the one-day strike, now they're going into the 3-day strike. They're not ruling out an all-out general strike. That's certainly something still in the equation.
Belle, thank you so much. Annabelle Drulers, our tech reporter, of course, there. Right, some other stories that we're tracking at this point in time. So Reuters is reporting the China Construction Bank is slashing pay, speaking of, for employees at its headquarters by at least 10%. High-ranking officials will reportedly take even steeper cuts in salaries as the lender tries to reduce their costs. Now, pay cuts at CCB subsidiaries have so far been deeper than those taken by staff at its headquarters. Now, Chinese EV giant BYD sold a record number of electric and hybrid cars in the second quarter. Now, data compiled by Bloomberg show it shipped nearly 1 million vehicles over the period, solidifying a rebound here after a slow start to the year. Sales were driven in part by price cuts across most models earlier this year, as well as some upgrades to technology. Now, shares of Paramount jumped in extended trading after a New York Times reports that billionaire Barry Diller is exploring a takeover bid. Now, his digital media conglomerate IAC has reportedly signed non-disclosure agreements with the controlling shareholder Paramount National Amusements. Now, Diller's interest comes after Skydance's takeover bid fell through. Bloomberg has learned that Bridgewater Associates is launching a $2 billion fund that uses machine learning in its decision-making. Now, sources say the fund began trading Monday with capital from more than half a dozen clients. We're told the hedge fund giant is leaning on its own technology, but the new fund will also broaden to include other models from OpenAI, Anthropic, and also from Perplexity. Right, that's a wrap of stories for now. We'll get to you a markets and potentially weather update coming up here on the China Show. Beautiful look at Shanghai this morning. That is, of course, the Pearl TV Tower in Lujia's Way. This is the China Show. A look at some political stories we're tracking from around the world. The U.S. Supreme Court has ruled that former President Donald Trump has some immunity from criminal charges over his alleged efforts to overturn the 2020 election results. The justice has ruled for the first time that former presidents are shielded from prosecution for some official acts taken while in office. Let me rephrase that. For clarity, the move has dealt a near-fatal blow to the push by prosecutors to go to trial before the November election.
No one is above the law, not even the President of the United States. Today's Supreme Court decision on presidential immunity, that fundamentally changed. For all practical purposes, today's decision almost certainly means that there are virtually no limits on what the president can do.
Now, Bloomberg has learned that the Democratic National Committee is considering formally nominating President Biden as early as mid-July. Now, sources say a potential date for the nomination, mark your calendars, potentially is July 21. That's when the Democratic Convention's Credentials Committee meets virtually. The DNC says the plan is not a response to the fallout from Biden's poor debate performance. Now, Singapore is lowering the threshold for checks on cash deposits received by casinos in a bid here to prevent exploitation by terrorist and criminal groups. The new rule will require casino operators to conduct due diligence checks on deposits of 4,000 Singapore dollars. Just for reference, the current level is at 5,000. Now, Australia's opposition to Liberal National Coalition is promising to build the country's first nuclear reactors if it wins next year's election. Now, they say the plan will deliver cheap, clean, reliable electricity, but the Albanese government is dismissing the idea. Our colleague Paul Allen explains.
Of all Australia's mineral riches, perhaps the most underused is uranium. About 1/3 of the world's reserves are here. Despite the abundance, Boss Energy is one of just 3 companies producing uranium, and all of it is exported. The country's opposition Liberal Party wants to change that with a plan to build up to 7 reactors on former coal-fired power station plants to ensure energy security.
I'm very happy for the election to be a referendum on energy, on nuclear, on power prices, on lights going out, on who has a sustainable pathway for our country going forward.
There's no shortage of barriers to nuclear energy in Australia. Forget community resistance. Nuclear power is currently illegal, banned by a 1999 Act of Parliament. Assuming the law gets changed, there's still the issue of cost effectiveness. Major generators like AGL and Origin aren't eager to spend on nuclear.
If things go wrong, they can go very wrong, which is why modern nuclear facilities are built with safety in mind. And this can make them expensive. They can also be even more expensive if they're being built in markets that don't have experience in constructing nuclear power or nuclear supply chains, where there isn't supportive regulation, policies, or politics, or where there might be legal challenges. And unfortunately, Australia faces all of those hurdles.
And then there's time. Even if the other hurdles are overcome, it would be 20 years before the reactors would be supplying electricity, a much slower rollout than renewables.
We know that Mr Dutton wants to slow down the rollout of renewables, and he wants to introduce the most expensive form of energy that's slow to build. But today, we've seen no costs, we've seen no gigawatts, we've seen no detail. This is a joke.
Australia does have one operational nuclear reactor, this research facility at Lucas Heights on the outskirts of Sydney. It mainly produces cancer medication. At this stage of the nuclear debate, it seems unlikely to be joined by any more.
And that was Paul Allen there, of course, reporting. Now, another story we're tracking, and as promised, a weather update. So Hurricane Beryl is barreling, and not to borrow a phrase there, certainly when you look at some of the reports coming through, a substantial system coming through that part of the world has neared a Category 5 strength. This record-breaking storm heads towards Jamaica. Now, the U.S. National Hurricane Center says maximum sustained winds have increased to almost 250 kilometers per hour, with even higher when you talk about gusts. Now, the Atlantic hurricane season is actually running ahead of pace, usually seen this time of the year with storms, 3 storms already recorded. Now, President Biden is due to speak on extreme weather, of course, later on Tuesday. And speaking of here we go. Yeah, so Hurricane Beryl has now, in fact, become, breaking news, the first Category 5 hurricane in the Atlantic before mid-July. And, Steve, just give us more context on this as well.
Well, bring up the map and you can see the trajectory of this storm, which is now Category 5. This is extremely early for this type of storm, this size of storm, especially in this region where it's just going off the northern coast of Venezuela, just below Dominican Republic, Puerto Rico, and Cuba, and heads towards the Yucatan Peninsula and then towards Mexico, as you can see. Now, this one is not projected to track northwards into the Gulf of Mexico in those oil-producing areas of the United States. But still, this particular part of the Caribbean doesn't usually see its first hurricanes until late August. Okay, and so this also is kind of a harbinger with this size storm, hurricane coming this early in the season is a bit of a harbinger for perhaps more extreme weather events for this summer typhoon or hurricane season.
Yeah, and the magnitude of Category 5, right? Typically, you could see things like complete wall collapses, ceilings blowing off, for example, power outages in terms of the disruptions that potentially could happen, of course.
Well, there's a 5-step Saffir-Simpson scale of hurricane strength. Number 5 is the highest. That will tell you.
We'll keep you guys updated, of course, and we'll be hearing more on the storm. But now, you just heard it here, breaking news, becoming the first Category 5 storm, I believe, this year. Okay, let's, in terms of the market reactions, right? So Steve was just talking about the implications of this as well. I mean, oil markets are already trading, not a pronounced move, but effectively, if you draw this back a couple of weeks, we're now at about 2-month highs. On West Texas, for example, 0.2% to the upside. Brent is trading about 0.3%. I'm looking just about across the oil curve. And by the way, if you add yesterday's move as well, you're talking about a move about 3% from about this time yesterday. Across the curve, we are up 83 in August. I'm talking about West Texas here, all the way down to about 70, 77. You look all the way to June of 2025. Okay, the other breaking news this hour, and one stock that we should be tracking, although the stock is suspended over in the Philippines, is Jollibee. So an announcement now from the company that it will be spending quite a bit of money, $340 million, that's US dollars, to acquire a 70% stake in Compose Coffee that's in South Korea, along, of course, its broader strategy of becoming one of the world's 5 biggest food and beverage companies. That's a step closer, I guess, to that specific endeavor. $340 million US dollar deal here. Right, glance at treasuries right now, following the melt-up we had over the last 2 days or so, the worst 2 days for treasuries going back to about April of this year. We're seeing that pull back a little bit as we speak. Bloomberg Dollar Index indicating some dollar strength coming through in these markets. Thank you for joining us these last 2 hours or so. That's it from us here on the China Show. Bloomberg Markets Asia is just ahead. This is Bloomberg.